Hello everybody, this is Lara from Pure Elliott Wave with a supplementary video for you. I'm going to try and explain a concept I keep referencing about proportion between second and fourth waves in commodities and cryptocurrencies with some visual examples. I'll still do my regular Bitcoin, Ethereum, XRP update later on today. So I keep pointing out that within commodities and cryptocurrencies, the fourth wave can often be more brief and shallow than its counterpart second wave, giving an impulse a three-wave look like a zigzag. You want to label it a zigzag, but if you look back at previous movements that are so very obviously over, a bull market's been followed by a big bear market, and the bull market has to be labelled as an impulse because it's the only structure that's going to fit now. You look inside that impulse, you'll see these examples coming up again and again. I've been analysing the gold cash market for about 13 years, and for the first couple of years I was expecting fourth and second waves to be proportionate, and I kept being surprised by the fourth waves being more brief and shallow than I was expecting. They kept putting me off. And so it took me a little while to learn that that's how commodities unfold the impulses. It's common knowledge in trading and technical analysis that commodities have a strong tendency to blow off tops and sell in climaxes. Have a look at the oil chart. You'll see, I think it's the 2011 high forms a sharp peak, and that huge low in 2020 where futures went negative briefly, that forms a sharp V bottom. That's a typical behaviour of commodities. When you put that into an Elliott wave structure, that's the end of an impulse. It's the fifth wave. And it's common knowledge in Elliott Wave that commodities have a tendency to very swift, strong fifth waves. When the fifth wave has that much energy, it forces the fourth wave that comes before and sometimes also just after to be more brief and shallow than its counterpart second wave. That's what I keep saying, but I'm going to show you some examples of older pieces of movement which are very obviously over. So it's rather difficult to label them as anything other than an impulse. Let's get into it. So I've been analysing this market for about 13 years, and I keep seeing this happen over and over. Let's look at some examples on gold. This is within the bear market that ended in, I think, December 2014. A really important bear market. I've got it labelled as a double zigzag. Within a double zigzag, there will be impulses, and here's one. This is an impulse for minus C, beginning here, ending here. You are free to go back and look at these movements yourself and see if you can resolve the problem of proportion. I've given you the date and time stamps of the beginning and the end of the impulses I am considering, so I'm being very transparent here for you. Here, the second wave at minute degree has lasted 8 days, whereas the fourth wave has lasted just 1 day. The end of the third wave here is the strongest piece of movement. MACD shows us it has the strongest momentum, it obviously has the strongest range, strongest volatility. This energy in here has forced the fourth wave that came just after to be more brief and shallow than its counterpart second wave, giving the impulse of minor wave C a rather curved look. A slow start, acceleration through the middle, explosion at or near the end. Here's a few examples on gold within the same bear market. I have this as the end of the first zigzag in a double, with primary C beginning here and ending here, unfolding as an impulse. Now, I've got 1, 2, 3, 4, 5. Really nice alternation. 2's a zigzag, 4's a triple zigzag, and within the impulse of intermediate 3 we've got a flat for 2 and a zigzag for 4. Great alternation, but not good proportion. Here intermediate 2 lasted 14 days, intermediate 4 not too far off, but it is more brief, 12 days. Minor 2, the flat correction, lasted 23 days. Minor 4, the zigzag, lasted 13 days. The fourth wave, again, is more brief than the second wave. The exception is when fourth waves are triangles, and that's because triangles do tend to be really time-consuming structures. And when they're compared to a zigzag, which tend to be more brief structures, you'll get disproportion the other way. And here's an example of what I'm trying to explain to you works a lot of the time, but not always. There's nothing in this happens always. So here the fourth wave is 28 days, and the second wave is 5 days. But overall, I've learned to expect the fourth waves, especially when they come after strong movement, to be more brief and shallow than their counterpart second waves. Here's the last example I'm going to show you on gold. This is in a bull market. This is a third wave, at least that's how my analysis labels it, a third wave ending May 2011. And this is the fifth wave of the third wave, or minor 5. It begins here and ends here, and I have 1, 2, 3, 4, 5. The second wave lasted 6 days, the first wave lasted just 1 day, and it comes before a strong, sharp little fifth wave. There's a lot of energy in here, the momentum is stronger, the range and volatility is increased in this fifth wave, so typical behaviour for commodities. Let's go and move over to Bitcoin now as an example of how this works in cryptocurrencies. This is part of my basic big picture Elliott Wave count for Bitcoin. I'm not going to show you what's happening up in here. That's for my subscribers on my website, and I update this analysis every Monday for them. From the beginning of Bitcoin's price history to this high here in December 2017, this fits so beautifully as a 5-wave impulse, and it's followed by a year-long bear market, which I've got labelled second wave, and this is the first time-consuming bear market that Bitcoin had. This one lasted a whole year. None of these previous bear markets lasted that long. So the proportion is good to see 5 steps forward, 3 steps back. We're going to have a look inside this. We're going to have a look at some examples in here, and I can't show you the bigger picture for that, but we're going to have a look at some examples back in here. So the first example, we're looking at the end of this impulse. It's got a beautiful curved look. You can see the problem with the proportion at a higher time frame, even here at the monthly time frame. This is an example of parabolic growth. And when you have parabolic growth, you have time-consuming second waves and brief and shallow fourth waves. So let's look at our first example. So here we have the end of that bear market and the end of the first impulse up out of the bear market. So I'm labeling it 1, 2, 3, 4, 5. This has a pretty good look, but here you have wave 2 lasted 46 days and wave 4 lasted 5 days. If you want to label this movement as a zigzag, feel free, but you have to fit that into the bigger context and have it make sense in your Elliott Wave structure. Let's look at the second example. We're going to look in here again with a newer movement from this low to this high. I'm labeling this movement as a complete 5-wave impulse. Now 1, 2, 3, 4, 5, that has a pretty good look, right? This looks like a 5-wave impulse, but within it you've got this piece of parabolic growth and you've got this huge energy here, and it leads to the second wave lasting 10 days and the fourth wave, it's lasted only 1 day. You're free to try and resolve this problem by labeling it a different way, but you have to have your 3s as 3s and your 5s as 5s. This is, I think, the best way to label this movement. Third chart, we're going to look at the end of a bearish movement now to see if it can work in both directions. And I'm labeling this bear market as a complete double zigzag, and within the second zigzag, here's wave C, beginning here, ending here, a 5-wave impulse. We've got 1, 2, a double combination, 3, 4 a triangle, and 5 relatively short. 3 is the longest actionary wave. Now the problem here is an enormous disproportion. 2 has lasted 59 days and 4 has lasted only 9 days. Now again, you're free to have a different Elliott Wave count that sees this movement as a zigzag, but you're going to have to fit that into the bigger picture. Let's have a look at an example where it doesn't always work, and this, I want to highlight this next chart because I want to show you it doesn't always work this way. It works more often than not, but not always. Same bear market, and I'm seeing it as a double zigzag, and within the second zigzag, here's wave A, and it's an impulse, beginning here and ending here. 1, 2, 3, 4, 5. Here, the fourth wave lasted 19 days, nearly twice the duration as the second wave. So sometimes the fourth waves are not more brief and shallow. This is a tendency, not a certainty, but it does happen more often than not. Let's look at the next example, chart 5. An impulse, which I've labelled a C wave within a B wave zigzag, beginning here, ending here. I've got the date and price stamps here so you can look at this movement yourself and see if you can see it a different way. The second wave lasted 12 days, the fourth wave lasted 5 days. Next example, the end of this year-long bear market ending December 2018. I have this year-long bear market as a simple zigzag, A, a diagonal, B, a triangle, C, an impulse. The impulse of C begins here and it ends here. Intermediate 2, a flat correction, lasted 19 days. Intermediate 4, much more brief and shallow, lasted only 4 days. Let's look at within this previous bull market. Now, you're free to label from this low to this high differently. I'm going to label it most likely as a complete 5-wave impulse because it has beautiful proportion, a really good perfect alternation, a really good look, and it's followed by a year-long bear market. So I'm reasonably confident that this is most likely the correct wave count. Within primary wave 5, let's look at this movement here, the end of the triangle for the 4th wave, and the 5th wave in here, beginning here, ending here. The 2nd wave within this impulse lasts 14 days. The 4th wave within the impulse lasted only 1 day. The strength of this upward movement for the 5th wave is so strong it forces the 4th wave that came just before it to be more brief and shallow than its counterpart 2nd wave. It gives the impulse a curved look because that's how parabolic growth works. You start out slowly, you accelerate through the middle and explode at the end. And the final example, a really extreme example, is the 5th wave to end a 3rd wave 1 degree higher. This is where we see parabolic growth at its most extreme. So here's the beginning of the 5th wave, here's the end of the 5th wave. Minor wave 2 lasted 72 days. Minor wave 4 over in just 1 day. Now you are absolutely free to label this impulse differently, but you're not going to be able to get rid of the proportion problem because this 2nd wave correction obviously begins here and ends here, and it did last 72 days. You can't find anything else in here that's going to last 72 days, and that's because the power of the 5th wave to end the 3rd wave impulse 1 degree higher, particularly this portion here, this vertical upward movement, the energy in here is forcing these 4th waves to be more brief and shallow. And so when I keep saying I'm comfortable labeling an impulse in a cryptocurrency with a 4th wave that is brief and shallow compared to its 2nd wave, if I'm seeing parabolic growth, then I'm going to be expecting it could happen. It won't always happen like that, but it will often happen like that. And so herein ends my explanation of what I keep saying, and I'll use this video as a reference in future for people who have a problem with me labeling it like that. And you're absolutely free to do a complete Elliott Wave count on Bitcoin and resolve those problems I've just shown. Contact me via the contact form on my website, and then you will be able to send me your chart and show me exactly how I'm wrong after you've resolved those problems of proportion. If I would be really happy, to be fair, if someone could do that. I don't think you can though. That's it for the end of this video, and I'll have your regular daily update coming soon.